We are delighted to speak today with Roger Hilty, partner at LGT Capital Partners, about the hedge fund industry, the current market situation, and his personal experiences. Hello, Roger. It's a great pleasure to have you on our podcast show.
Hello, Moritz, and thank you very much for the invitation.
You have been working in the hedge fund industry for 20 years by now. What fascinates you about it every day, still today?
The hedge fund universe is a fascinating space, and many call it the innovation pool in asset management. Hedge funds are often at the forefront of new investment techniques, and they actually explore new markets and unique data sources. This enables them to generate alpha. Hedge funds also started to harness alternative data sets such as social media, news, and many more to gain superior investment insights. There are around 15,000 hedge funds globally, and in our job, we really have the benefit of talking to some of the best money managers in the world. And that is truly exciting and has been motivating me over the last 20 years.
You hold a bachelor degree in business administration and an MBA in finance from the University of Liechtenstein. When we spoke earlier, you mentioned that you are from Switzerland. So, how did you get to study business administration in Liechtenstein and then join the LGT Bank?
A colleague of mine working in portfolio management at LGT in Vaduz back then knew me from the cycling team. He was actually so kind to hand in my CV to the HR team at LGT in Liechtenstein, and subsequently I was invited to a job interview with the head of trading treasury at LGT Bank, and that's where I got my first job there. The university in Liechtenstein was a great opportunity for me to study finance full-time, but also continue to work part-time at LGT, basically on public holidays, vacation times of others, and doing the night shift in the trading treasury team that went up to 11 p.m. at night, something that wasn't actually so popular for others, especially the ones with family.
Was this all already clear to you from the beginning, and did you have specific early career goals?
No, not from the beginning, but after competitive cycling, I definitely wanted to study. And during my bachelor's degree, I was fascinated by mathematical economics, investments, and portfolio management, and then decided to do my MBA with focus on finance, with the goal to later on find a job opportunity in the investment world.
In 2004, you transferred from LGT Bank to LGT Capital Partners, so within the LGT Group. Could you perhaps explain what different business areas the two companies cover within the LGT Group and what motivated you to pursue your future career in the hedge fund industry?
Yes, of course. The LGT Bank is focused on the private banking business, whereas LGT Capital Partners is the asset management part, where we have a particular focus on alternative investments.
Very interesting. But now let's talk a little bit about hedge funds in general. This podcast is a brief introduction to hedge funds. So let's start right at the very beginning. Roger, what is actually a hedge fund?
Sure. So hedge funds belong to the category of alternative investments, and each trades a unique investment strategy to generate alpha. A hedge fund manager runs a pooled investment fund that can hold liquid assets across global equity, fixed income, currency, and commodity markets. They then trade positions actively, long and short, typically with reduced directionality and low market beta. Their ambition level is to deliver absolute returns, meaning positive performance in any market environment, regardless whether markets go up or down. They can use leverage and derivative instruments such as options and futures, and their trading and risk management techniques are often quite complex. If you compare them to classic mutual funds, hedge funds typically charge a management fee of 1 to 2% per annum, plus a performance fee, typically 10 to 20%, of the increase in the fund's net asset value. They're also, here compared to mutual funds, harder to access than other investment vehicles, and regulations often require that hedge funds can only be marketed to institutional investors and high net worth individuals.
All right, but why should you invest in hedge funds at all if most of them don't beat the market over a longer period of time? What are the main reasons?
Hedge funds have delivered consistent positive performance for us over multiple market cycles with relatively low volatility. As a principal investor, we like their uncorrelated performance with low market beta. Hedge funds have a significant allocation in our portfolios today, and they helped to make our multi-asset portfolios more robust, especially in periods of dislocated markets such as the global financial crisis in 2008, during the COVID pandemic, or in the year 22, which was difficult for traditional markets. With hedge funds, we can access unique sources of performance. For example, we get actively traded currency and commodity market exposure that is actually hard to get elsewhere in the asset management industry. And we can access unique investment strategies right now in the areas of AI, artificial intelligence, and machine learning in the group of systematic hedge funds.
Roger, in your opinion, what are the most important hedge fund strategies one should know about? What do they have in common? How do they differ?
Hedge funds employ a variety of strategies, and they can range by asset class, style, region, sector, and market exposure. At Capital Partners, we differentiate between discretionary and systematic hedge fund strategies. Discretionary hedge fund strategies involve investment professionals, people making the final investment decision, while systematic strategies rely on computer-based models that generate investment signals to construct the portfolio. And furthermore, then within each category, there are several sub-strategies.
Can you also say something about the risk and return of this asset class in general and the different strategies in particular?
Absolutely. So a large category, the biggest universe of all hedge funds globally, are the so-called long-short equity managers. This is an investment style where hedge fund managers take both long and short positions, and they select individual stocks to exploit inefficiencies through an informational edge, rigorous fundamental and technical analysis. And we can further then divide these managers into three sub-strategies within long-short. The first one are the all-rounders. They trade global equity markets, but still focus on certain market segments such as sectors, market capitalization, etc. But these hedge funds, the all-rounders, they're very flexible and opportunistic in their allocations. The second is regional or sector specialists. So these are equity long-short managers that focus on a relatively narrow set of sectors or countries with the clear goal to identify winners and losers. And the third one are the trading-oriented long-short equity managers, strategies that in addition to stock selection also use an assessment of the market environment for directional positions in sectors and countries. The second large subgroup within discretionary hedge funds is called relative value hedge fund managers. The objective here is to generate returns which have a minimal market exposure or beta by simultaneously trading long and short positions. These strategies benefit from mispricing in the market, liquidity mismatch, regulatory changes, or irrational behavior. The most common sub-strategies within relative value are convertible bond arbitrage. Here, a strategy that unlocks inefficiencies between the convertible bond and the reference stocks. And the second one is fixed income arbitrage. Here, hedge fund specialists exploit price discrepancies in interest rate securities, and they take advantage of small price differences while they limit their exposure to interest rate risk. And the third large category within discretionary hedge funds is event-driven. Event-driven is an investment style that groups together strategies that take specific positions focused on single transactions or one-off events. These events can include merger and acquisitions, could be distressed opportunities, credit events, and many more. Also here, we know from the press basically three main sub-strategies. The first is merger arbitrage or risk arbitrage, as some call it. It is a hedge fund strategy that exploits the uncertainty premium involved in merger and acquisition transactions. Here, these hedge funds focus on mergers, acquisitions that are typically more complex in nature and involve quite a high degree of uncertainty as to whether the transaction will close. The second sub-strategy in event-driven is credit long-short. A large universe of managers, they focus on the debt side of balance sheets with an emphasis on identifying relative mispricings within the capital structure. And a key part of the strategy is analyzing the detailed legal covenants for debt securities and identifying differences in the treatment of certain debt holders that may be misunderstood by the market. And the third and last event-driven hedge fund strategy is distressed credit. Here, the goal is to unlock value in failing companies by buying distressed securities. Hedge funds typically buy securities, often bonds, of companies that have already announced bankruptcy or where the market expects bankruptcy of the underlying company, and they then hold the securities until convergence to fair value. And one last, another important discretionary hedge fund strategy is discretionary global macro. These hedge funds analyze and capitalize on major shifts in global economies. They identify macroeconomic trends. They look into data points such as interest rates, economic growth, inflation, currency movements, political events, and many more. Their trading style is highly opportunistic, and they have typically substantial position sizes in the themes they trade.
This is very interesting, Roger. But what about systematic hedge funds? You mentioned the rise of machines earlier.
Absolutely. So this is 50% of what we actually do, and here we differentiate between two major hedge fund categories: managed futures CTAs and quantitative equity hedge funds. Managed futures CTAs, these are terms often used for systematic hedge fund managers that trade global futures markets across all asset classes. And also here there are different major sub-strategies. The largest and the oldest one is trend following CTAs. CTA stands for Commodity Trading Advisors. They not only trade commodity futures but also all financial futures and FX forward markets worldwide. They have been around since the early 80s. These CTAs identify positive and negative price trends that they capture with different investment speeds. And as the name says, they follow trends in global equity indices, sovereign bonds, interest rates, currencies, and global commodity markets. The next category is something of a newer development, but also has been around for a number of years: trend following CTAs that focus on alternative markets or so-called exotics. These hedge funds employ similar investment techniques as classic trend following CTAs, but they focus on a much wider set of markets, especially alternative or exotic market instruments. These could include interest rate swaps in emerging markets, European carbon allowances, power markets, credit instruments, or onshore Chinese commodities that we trade through swaps through Western banks, and many more. Another sub-strategy within managed futures that actually became smaller given the macroeconomic environment since the global financial crisis is systematic short-term trading. The barriers to enter are very high here. The investment strategy is key, but short-term trading is also an infrastructure game. It requires massive computer power and data. These systematic hedge funds trade global futures across all asset classes, but they have a very short holding period per trade that ranges just from a couple of hours to a few trading days. And then another one and growing hedge fund strategy within managed futures is quantitative or systematic macro. These hedge funds trade based on all available macroeconomic data points, similar as discretionary global macro hedge funds that we discussed before, but quant macro managers use computer-based investment models to generate their trading signals. Some of these hedge funds trade market-neutral portfolios with limited directionality, while others have clear directional exposure in the way they invest and capture opportunities. Bridgewater, one of the largest hedge funds in the world, actually belongs to this category. Now that's managed future CTAs as one part of systematic hedge funds. The other one, the second one, is quantitative equity hedge funds. Here we talk about managers that trade thousands of single stocks using computer-based trading models to exploit market inefficiencies in small, medium, large cap companies and actually in emerging and developed markets. These hedge funds run market neutral portfolios and they rely heavily on advanced technology and data to maintain their competitive edge. And here at Capital Partners, we actually divide into two sub-strategies. Equity market neutral. These hedge funds use hypothesis-driven factors with a clear investment and trading logic behind, such as valuation concepts, momentum, growth, quality, and more proprietary factors to predict stock returns. The second category is also one of a newer development, but also here managers have been around for a number of years, is AI machine learning hedge funds, or as we call them, advanced quantitative investing strategies. They incorporate new techniques such as supervised machine learning, certain natural language processes, and other techniques coupled with the growing availability of data and new data sets to generate uncorrelated alpha. These strategies are typically non-hypothesis driven and self-adapting to changing market conditions. They're also higher frequency in their trading style and can include nonlinear and other complex signal expressions, which can make return attributions here more challenging with these strategies. These hedge funds typically minimize exposures to common risk factors, or they even residualize market risk factors. And as we have seen it, they delivered higher risk-adjusted returns and Sharpe ratios.
Let's take a look in the past for a moment. How have you perceived the last few years? Have these been the best years for liquid alternatives given COVID, interest rates and war?
Sure, there has been a very strong pickup in performance for hedge funds, and actually since 2018. Many investors we speak to are actually quite surprised when they see how strong hedge funds performed over the last 5 years, and also through 2022 when equity and credit markets were down together as their correlations changed. With the COVID pandemic in March 2020, we saw a massive policy response by global central banks and policymakers. Major trends got accelerated, and finally, years after, we saw inflation coming back and bringing us into a new investment paradigm with a record rise in nominal interest rates as the central bank response. Central banks since are data dependent and they focus in particular on inflation. Markets are on their own, they're focused on fundamentals again. The central bank put, as has been around for years, is gone. Inflation has taken the lead, and this is an attractive investment environment for hedge funds.
Let's take a look at the future now. What investment trends do you expect to see in the hedge fund industry this year, and which are most interesting for institutional investors and ultra-high net worth individuals?
We have left the ultra-low interest rate environment and that we all experienced since the global financial crisis in 2008. And this new environment that we currently experience with higher cost of capital or higher cost of debt creates dispersion. We also see major technological innovation, big data trends. This creates opportunities in a data revolution. The energy transition is happening and leads to trends in commodity markets and many more. So overall, we are in an attractive investment environment for various hedge fund strategies. We continue to invest into hedge funds that apply some of these newer advanced quantitative investment strategies such as AI, machine learning. We actually launched our third segregated managed account on the 1st of February with a large manager in the United States in this area. There is an attractive dispersion in several equity sectors, in healthcare, in financials, and in energy, in the energy complex. We have pushed forward with long-short equity sector specialists in these areas. We continue to onboard new markets to our managed accounts to access additional sources of performance. For example, we access additional markets in mainland China through customized accounts. Markets in China that are actually very hard to access for offshore capital. And we see good opportunities for active credit hedge funds that focus on European and US credit markets.
Where will be the biggest challenges for hedge funds in 2024?
The US Fed pivot is widely debated and many interest rate cuts are currently priced into the curve. We will see how that plays out. It is rather hard actually to imagine that central banks enter an aggressive easing cycle while we see equity indices, especially in the US, at these levels, certain stretched valuations, continuation of low unemployment rates, and very resilient economy, strong consumer, especially in the United States. So there could be some disappointment about rates, and nominal rates may remain at least higher than expected for longer, but in fact, nobody knows. There is also substantial geopolitical tensions in many parts of the world, unfortunately, and we have an upcoming US election. So we are definitely in an environment of higher uncertainty, higher macro volatility and dispersion, and this creates an attractive investment opportunity set for hedge fund strategies as they actually can reposition themselves quite fast. To the question, the worst for hedge funds would be a return to an environment of ultra-low interest rates as we have seen it over the last decade, with low market volatility, interventions on a constant basis, a central bank put that always protects asset markets whenever there is a dislocation. But given all the different macro forces as we currently see them at play, we believe it is highly unlikely that we are going back to that one.
Now let's dive a little deeper into LGT Capital Partners. If one wants to invest in liquid alternatives, why should they do this specifically with LGT Capital Partners, and what distinguishes you from other asset managers in this area?
We have built a strong investment team of hedge fund analysts in Hong Kong, New York, London, and our Switzerland offices with a global network. And LGT Capital Partners has been running hedge fund portfolios for 25 years, and we built our customized managed accounts or hedge fund platform already in the year 2000. Beyond that, we actually customize a lot of our hedge fund managers and do not just invest into their off-the-shelf flagship offerings, but we make them a better fit to our portfolios, and we especially focus on a market-neutral implementation. Today, we manage approximately 8 billion in hedge fund strategies, and we combine for our clients various different sub-strategies, 50% discretionary hedge funds, 50% systematic, that our clients can actually invest into pooled vehicles that give them instant access into all kind of hedge fund sub-strategies that are available and broadly diversified exposure. But most important is our passion and the ambition level to deliver the best possible performance to our clients.
In which of the mentioned hedge fund strategies do you invest as LGT Capital Partners, and in which do you have special expertise?
We actually invest into all of the before mentioned relevant hedge fund strategies that are available. Sizing depends on the environment we are in. Compared to others, I would say at LGT Capital Partners, we have a substantial allocation to systematic hedge fund managers, quantitative hedge fund managers. We always had a significant commitment over these 20-25 years, and today we have an allocation of 50% systematic hedge funds in our portfolios.
Please explain us, how do you invest in these different strategies?
Our preference is through customized managed accounts on our platform. But we also invest in fund for one structures that are specific for LGT, or then classic into offshore hedge fund structures, if that is the only option for us to get exposure.
You manage your hedge fund investments via your managed account platform. How does that actually work?
It's actually quite a complex setup that we started to build in the year 2000, and we have a deep team behind today. But how it works is actually quite straightforward. So what we do is we identify and select hedge funds. We then negotiate that they trade an LGT account for us and their strategy basically traded parallel to their flagship fund. We measure the tracking error that they do exactly what they're doing within the flagship fund, but we have access to all the data. So with a managed account on our platform, all our analysts and risk managers, portfolio managers have full position level transparency into these hedge fund managers. It is a ring-fence platform. There is no cross liabilities, and we can actually also apply leverage for higher capital efficiency.
How do you research and find new interesting strategies and funds? What to consider in particular during the due diligence of new investments?
So our global hedge fund investment team is constantly, every day, screening the universe for new hedge fund talent. That's a lot of work, given that there are up to 15,000 hedge funds worldwide. Our network through hedge fund service providers, prime brokers, cap intro services, and obviously many direct industry contacts helps us to be on top of new hedge fund launches early. But managers also know us as an allocator and reach out to us quite early on, in many cases actually before they even started. Each analyst then conducts an in-depth quantitative and qualitative analysis on a specific hedge fund manager with, as we call it, a full due diligence on such investments to verify how such a strategy could fit into our portfolios.
How do you get access to exclusive strategies? Which role does LGT Capital Partners' reputation and network play in this process?
The reputation and our network is key to access limited capacity and identify high quality hedge funds early on. We then also negotiate capacity agreements in so-called side letters with these managers.
What is the minimum investment amount you need to invest with LGT Capital Partners to be able to invest in hedge fund strategies? And what about typical hedge funds?
We have retail share classes for 125,000 US dollars and other currency denominations. Most hedge funds, if you go and invest into them directly, they have relatively high minimum investment thresholds, typically 1 million minimum or even 5 million. In some cases, there are even multi-strategy hedge funds that do not even take investors below an investment size of 25 million, but that is rather extreme and actually a rare exception.
Who invests with you? Are these mainly institutional investors or also private clients?
It is both. We have a broad global client base of institutional investors, but we also focus on wealth management and high net worth individuals.
In your opinion, should hedge fund strategies be an integral part of every portfolio? And what percentage of the overall portfolio do you recommend to invest in hedge fund strategies to different investor groups?
We strongly believe so. The LGT Endowment Fund, the Princess strategy, has currently a 20% allocation to hedge funds, and we have high conviction in these strategies in the market environment we're in. The percentage allocation to hedge funds depends a lot on the other investment positions an investor holds in his or her portfolio and what this client wants to achieve ultimately in terms of risk, return, and drawdown characteristics. We like to engage with investors early on, analyze their existing portfolio, and then come up with concrete proposals for a specific hedge fund allocation based on the investor's portfolio objective function to then ultimately achieve the best possible result.
How do you keep yourself personally informed about market developments and the hedge fund industry in general? Which interesting medias you would recommend to everyone?
I'm also a member of the LGT Capital Partners Tactical Asset Group, and it is our job to be actively informed about global markets and macroeconomic dynamics. As such, we have access to all classic financial information systems where we have licenses, for example, Bloomberg and many more. We have access to a fantastic research and market opinions produced by our hedge fund managers that we can access. There are several financial websites that are free and have strong content these days, and growing in relevance social media sources like X, former Twitter, LinkedIn, and many more that play a more and more important role and are platforms how information is exchanged freely.
Now, a little bit on your personal experience in this industry. Could you describe a typical workday if one even exists?
Every day is indeed different. The clear focus is always on portfolios, performance, and global markets. So we spend a lot of time with our global investment team every day. We discuss hedge fund investments, specific sub-strategies, and new opportunities that might come up. And we work with our investors in a close dialogue when it comes to portfolio updates or specific hedge fund investment discussions.
Very interesting. But what are the main daily responsibilities as a partner in the hedge fund division?
It is about the team, the hedge fund portfolios, the investments, and our clients. It's a lot of hard and honest investment work every day where we focus literally on every single basis point in terms of performance, but also cost. We're very cost sensitive, want to reduce also the cost side of our platform and our portfolios and have high operational efficiency.
You have been working in the industry for several years by now. What are the biggest changes you have seen over the years?
The machines continue to take over. We see a major data revolution has happened over the last many years and is growing fast. Many hedge funds have more and more computer and systematic trading support to handle the massive volume of data that we all experience these days. Next to classic market data, we see a growing relevance of non-traditional data sets such as social media, news, credit card information, cell phone tracking devices, and many more. This is complex data, which is expensive. It needs data cleaning before you can trade on it, before you can work with it. A lot of these data sets are not relevant for trading as of yet, but will become with a growing volume. The ultra-low interest rate environment with low market volatility has led to the closure of many systematic short-term trading CTAs. That's why I mentioned that that space and that category has shrunk a lot, given that the investment opportunity set for them post the global financial crisis has been unattractive. So they are literally just not around anymore, many of them. We also saw a broader universe of systematic global macro managers emerging. There has been a lot of discretionary global macro firms, but it has become harder for people to trade global futures markets selectively and successful with consistent, solid risk-adjusted performance. So we also ourselves, we replaced many of our classic discretionary global macro hedge funds with machines, such as so-called quantitative macro hedge funds.
Now a little bit about your personal experiences. What is the best investment advice you have ever received, and which advice would you like to give to every investor?
We like systematic hedge funds a lot because the machines are unemotional. They never sleep, never have a sick day. They continue to execute their investment strategy with discipline in the market, regardless of what is happening. So unemotional. I think emotions are typically not very helpful when it comes to investments and portfolio management. When looking at hedge funds, my key question is always on the alignment of interest. So how are the key investment professionals at a hedge fund responsible for managing that portfolio, how are they personally invested themselves? Are they co-invested in their strategy? Skin in the game, as we call it. And if there is not a strong alignment of interest, I see no reason why we should allocate to them.
What mistake do you often see young investors make when they start their career at LGT Capital Partners?
I think we have a lot of smart and intelligent young people at our firm who step by step build their knowledge when it comes to investment management. The most important lessons that I personally will never forget, those were the ones that I experienced with investments on my own capital. I learned many things the hard way, tried out new things with all types of securities, using derivatives, leverage. And some of these lessons were quite expensive and created indeed some sleepless nights.
Let's now turn to a very important topic of our time. Which role does ESG and sustainability play for your investors, for LGT Capital Partners and the hedge fund industry in general?
LGT is very focused on sustainable investing criteria, ESG, greenhouse gas emissions, climate change. We have very specific criteria how we manage our own portfolios. For example, we have a dedicated LGT Group single stock exclusion lists for certain sectors, as an example. Our managers, where we have a segregated account, they actually do not trade those stocks as we exclude them from the portfolio. Our investors are very aligned with us and appreciate our sensitivity to these topics. We also rank and score our hedge fund investments within an ESG framework, and we also actively engage with managers on these topics.
When young students listen to this podcast who are also looking for a career in the hedge fund industry or want to join LGT Capital Partners, what would you like to give them along their way, and how do you usually get there?
It is key to bring a strong passion for investments and markets. A solid financial background and education is crucial, given that this knowledge is needed in the daily work as an investment analyst or portfolio manager later on. But most important is a high ambition level and self-motivation to perform and go the extra mile. Investment management is a highly competitive discipline with a lot of ups and downs. So endurance and to never give up is key.
Yeah, to never give up is key. And it also applies to competitive sports. So before you started your professional career, you were a competitive athlete. How did competitive sports shape you and help you in your later career?
As an athlete, you definitely learn how to very much focus on a specific goal on a specific day. So you turn every stone, you train hard, you prepare yourselves to ultimately deliver your best possible performance in a competition. And the investment world is also highly competitive. And we find actually many hedge fund managers with an athlete background. A sports mentality definitely helps, as you need staying power and endurance in the ups and downs of global markets.
When you look back on your career, what was right and important? What would you do different today with all your experience that you have now?
It is important to spend enough time on studying and education when you're young, to be well prepared for the business life thereafter, because it becomes harder to catch up on education once you are in a job and once you get older.
Very interesting. Now for the end, what strategies does LGT Capital Partners pursue to gain an advantage over its competitors in 2024?
As a team, we continue to work hard every day to identify the best possible hedge funds in the world for our portfolios and our clients. We are passionate about hedge funds and we really love what we do. And we have a high ambition level to deliver the best possible performance to our clients.
Dear Roger, thank you very much for your time. We really appreciate it.
Thank you very much.